Perhaps not surprisingly, we've seen that over the course of the Industrial Revolution, which of course has been in different countries at different times, we've had an increase in globalization also. But perhaps what is surprising is that we've had two different phases of globalization. And the first one was really at the latter half of the 19th century and early part of the 20th century, up until about World War One. It was probably a little bit longer in the United States since the United States was not affected by World War One quite as badly. And you can see this graph just shows a measure of trade costs. And so it sets 1870 equal to 1, and any decrease then is a decrease in trade costs and therefore an increase in globalization. And you can see that it decreased fairly steadily up until the beginning of World War One in 1914, and then increased during the Great Depression and, of course, World War II. And so globalization, one, the economy of the United States in 1920 was a lot more connected to the rest of the world than the economy of the United States in, say, 1950. Um, Starting around 1950, we had what's called, globalization two, a second phase of globalization, in which trade costs have decreased again, and are back to a level basically where they were before World War One, right? Trade costs are never going to entirely disappear because there will always be some cost of transporting physical goods and services, at least until we get a Star Trek transporter. But for instance, tariffs are much lower now than they were back in the 50s or even back in the 1980s. So this gives an average tariff rate. So remember, a tariff is just a tax on an import. So, if you have a tariff on cars, then any country that wants to uh, export cars to your country has to pay a tax on it. So a tariff could just be a percentage of the price. As I said, we have tariffs on sugar. We have tariffs on a lot of goods, but they're a lot lower than they used to be. You can see that in high-income countries like the United States, the average tariff is a little less than 5%. The average tariff in low and middle income countries is more like 10%, but that's a lot lower than it was just 30, 35 years ago, where it was over 30%. So that's another measure of how globalization has increased over the last 35 years. Another measure of increased globalization is the capital markets. And so capital markets and goods markets are in some ways two sides of the same coin, right? Because when goods are flowing in this direction, we're going to have money flowing in the other direction. And there's going to be both money flowing in order to pay for those goods and services, but also money flowing for investment. And so the balance of payments records the sources and uses of foreign exchange, which include portfolio investment, meaning buying foreign stocks and bonds. So if you buy shares of um, Deutsche Bank in Germany, that's going to go into portfolio investment. If you buy a French government bond, that's going to go in portfolio investment. And then there's foreign direct investment, which is the ownership of foreign physical assets. So if Ford goes and buys a plant in China, that's foreign direct investment. If Sony buys a plant in the United States, that's foreign direct investment. And the relationship between these two is that the current account measures the net exports, so exports minus imports, plus net investment. And net investment will be the balance between the portfolio and foreign direct investment that U.S. companies and individuals do in other countries and what other countries, companies and individuals do in the United States. And so if the country has a current account deficit, so that exports minus imports plus net investment is negative, that means the country is borrowing compared to the rest of the world. And if they have a current account surplus, that means the country is lending. So if you're exporting a lot more than you're importing, or your net investment is very positive, you're likely to have a current account surplus. On the other hand, if you're importing more than you're exporting and your net investment is negative, then you're likely to have a current account deficit. So we can see these trends in capital flows. This goes back to 1870 and gives the absolute current account balances as a percentage of GDP for 15 of the richer countries. And you can see that it increased substantially in that first phase of globalization, and up to about 6.5% by 1914. It fell dramatically with World War I and with the Great Depression. Increased somewhat, but right before World War II, but then fell off again and really reached a low point around 1960. And a lot of this was due to regulations where countries put a lot of controls on who could own what, how much foreign direct investment there could be. That started to get liberalized in the 1970s, and foreign capital flows increased dramatically up until the global financial crisis of 2007, 2008, where it fell again. But I would expect that this would increase again. And we'll talk about both the costs and benefits of this in a little bit. But obviously, one cost is that if money flows in, it can be beneficial, right? Because it can create productive physical assets, but it can also create asset bubbles. It can change relative prices. And then if that money leaves quickly, then that can deflate asset bubbles, lead to crashes, lead to financial crises. And so there's been a little bit more support recently for putting in some of those capital controls that we used to have, although maybe hopefully doing it in a smarter way, in order to protect countries from some of the costs of capital flows. So we can see international asset holdings. So this goes back to 1900, and this is sort of a average for countries where it's just assets divided by GDP. And you can see that it was pretty low in 1900. It actually fell sort of all the way until almost 1950 when it started to grow again. And then, as we said, as those global capital markets were liberalized, meaning that countries took away some of those restrictions that they had put in place in order to control capital. As those restrictions were lifted, the international asset holdings increased pretty dramatically. And so you're much more likely to see money flowing between countries buying different assets, around 2000, 2005 than you were in, say, 1970. One of the interesting things is that sort of one criticism is that all of this investment from, say, U.S. firms are going to countries that are low cost, right? So we're moving factories to China, we're moving factories to Latin America, we're moving factories sort of to the low wage labor in order to take advantage of those places. But as we see, it's actually split about 50% in terms of going to high wage countries versus low wage countries. So 11.5% of U.S. firm investment was in the UK, a rich country. 10.7% was in the Netherlands. 8.7% was in Luxembourg. Whereas in terms of where the money was going, like for China, it was actually quite low. It was only 1% of that investment. And so the investment that comes from U.S. firms to other countries gets spread out to both rich countries and poor countries. It's not one or the other.